Welcome to Accounts, recording transactions in ledger accounts. Remember to subscribe when you watch the video. A ledger is a book of accounts where transactions are recorded, and an account is a chronological record where transactions are recorded. For example, all cash transactions are recorded in a cash account. That is, cash inflows and cash outflows in a business. A motor vehicle account deals with changes in motor vehicles in an organization. That is, if you buy new vehicles, the motor vehicle account increases in the value of motor vehicles, and when you sell motor vehicles, probably they are not in use, they are obsolete, they are not serving their purpose, you reduce the value of motor vehicles in a business. There are other accounts in a business, for example, sales account, salaries account, capital account, etc. All of them are kept in a book called the ledger. So each account occupies a page or 2 pages or so, and all of them are recorded or kept in one larger book called the ledger. So an account has the shape of capital T, as you can see. So the blue line and the red line forms the shape of a capital T. On the left-hand side of an account, we call that side DR or debit side. And on the right-hand side of the account, we call that side CR or credit side. In each of these sides, we have the date column, the details, the ledger folio, and amount. So date, details, ledger folio, amount. We look at the format of an account. At the top, we have the title or the name of the account. The title or the name of the account. It is centered or at the center top. Then we have the debit side on the left with a number of columns. It will depend on which type of account, but majorly all accounts have 4 or at least 4 columns. On the right hand side, we have CR or credit side. When come to columns, we have the date column, the details or particulars column, the ledger folio column, and amount column. So the date column is recorded the date when a transaction takes place. For example, on 20th of January 2010, we made sales. So the date will be written 20th, and then the details will be sales. Let's say sales equivalent to 20,000 will be entered here, 20,000. And that relates to the sales ledger or a book called sales ledger. Moving forward, we look at rules of recording transactions in ledger accounts. Accounts are divided into 5 major types or classes. We have assets, expenses, liabilities, capital, and revenue accounts. The asset accounts and expense accounts behave in the same way in terms of recording. So when an asset account increases, you record that transaction on the debit side. That is this side, left side. And when an asset account decreases, you record that transaction on the right side of an account, this side. The same applies to expense accounts. An increase, you debit, DR side, a decrease, CR side, or you credit. The opposite is true for liabilities, capital, and revenues. So, for liability accounts, when a liability account increases, you record that transaction on the credit side of that liability account, and when it decreases, you record that transaction on the DR side, unlike assets and expenses where you record the opposite side. The same applies to capital. An increase, you record on the CR side, and a decrease on the DR side. The same also happens to revenue accounts. An increase, CR side, and a decrease, DR side. Let us look at the specifics: assets, liabilities, capital, expenses, revenues. Rules of recording assets in the ledger accounts. Assets are resources owned by a business and can be used to produce economic value to a business. We have current assets and fixed assets. Current assets are resources owned by a business and can be convertible to cash in less than 1 year. For example, cash at hand or in the cash box, checks, bonds or shares. When you invest in a company, you can sell them anytime or you can buy anytime. Stock. In our case here, we are talking about the tangible items that a business deals with. For example, in a supermarket, we have utensils, we have detergents, we have unga, salt, bread, etc. Then we have debtors, those that buy from us on credit and pay us later. Then cash at bank, the money we have in the business account at the bank. Prepaid expenses. These are expenses that have been paid before they are used or consumed. For example, if you pay for water in January, but you pay extra money to cover for February and March, at the end of January, you will have prepaid for 2 months. That is your money. You can ask for it before you use it. It is an asset to the business. We also have accrued revenues. We have earned some revenue, but we have not been given by those that should pay us. It is also an asset to the business. Then we have fixed assets. These are resources owned by a business and cannot be convertible into cash in less than 1 year. For example, furniture, equipment or machines or tools, vehicles, buildings or premises, land. So we use these resources to operate the business, to make wealth of the business. We do not buy these items so that we sell them. We buy them so that we can use them to make more money in the business. Looking at an example of an asset account, we have motor vehicles. On the DR side, we said that an increase in assets is recorded on the DR side and a decrease on the CR side. If we buy more vehicles and increase the number of vehicles in the business, we record their value on the debit side of the motor vehicle account. And when we sell some vehicles, probably they have outlived their purpose in the business, we record the value of those vehicles on the credit side. Next, we look at rules of recording expenses in the ledger accounts. Remember, we said expense accounts and asset accounts follow the same rules of recording. So expenses are costs incurred in running a business. For example, insurance costs, salaries and wages, repairs and maintenance, advertising or promotion, transport, warehousing or storage, electricity, water, stationery, and other items that we need to run the business. Looking at an example, look at salaries account. When we incur salaries or salary expenses, we record that in the DR side, and a reduction of salaries is recorded on the credit side. We move on to recording liabilities in the ledger accounts. It behaves in the opposite of assets and expenses in terms of entries. So liabilities are debts of a business, and we have current or short-term liabilities and long-term liabilities or debts. So short-term liabilities or debts or current liabilities are debts that a business should pay within 1 year or accounting period. For example, creditors, those that supply us with goods or stock on credit, we should pay them promptly. Accrued rent or salaries, salaries or rent that we have not paid but we have used them. That is a debt that you should pay. Bank overdraft, that is a loan advanced by a bank to a business person so that they can solve their financial problems or needs in the short term. And when you pay bank overdraft, you pay with some interest. Then you have other short-term loans, loans from individuals and other organizations. Those are debts. Then you have long-term liabilities or debts. These are debts that a business should pay in more than 1 year or accounting period or financial period. For example, if you take out a loan of or from a bank and you should, or you've agreed to pay it in 5 years. So you'll not pay that debt in the short term or all of it in 1 year, but staggered for 5 years. So that is a long-term debt. Then you have circle loans. Most of the circle loans are long-term debts, mortgage, etc. An example, creditors account. When we borrow stock from creditors or suppliers, we are increasing our debt with them. And that increase is recorded on the CR side. And when we pay up those debts, we are decreasing our debt with suppliers. So we record that transaction on the debit side. We look at capital, rules of recording capital in ledger accounts. Capital is the wealth or net worth of a business. It is a form of liability to a business in that shareholders or owners expect returns or dividends out of the capital they contributed. So, if capital increases, you record that transaction on the credit side. And capital increases due to additional investments, either in cash, you inject cash, new cash in the business, or even stock, or even a fixed asset that was previously owned by others. You bring it into the business for use, probably a machine, a vehicle, or even a new building. It's part of capital. Profits also increase capital. And because we said capital is the wealth or net worth of a business, when you make profits, you have increased wealth or the shareholder wealth. Then we have drawings and losses. You can withdraw or draw cash, stock, or any other item from the business, and it is turned into a personal property. That means you have reduced the net worth of the business. It reduces capital. And also, losses reduce capital. Those transactions are recorded on the DR side. Let us look at revenues. Rules of recording revenues in ledger accounts. Revenues are incomes earned by a business from other sources other than the normal trading activities, that is, sale of products or goods in the course of the year. They include such items as commission earned, rent received, transport income, storage charges, and etc. A business may earn a commission for, let's say, selling a product of another company in large quantities. Or a business may store stock or goods for another business and they charge them. You receive that money in form of rent received. You can use your company vehicles to transport goods for other businesses. You are paid to transport that. So transport income, storage charges, etc. So when we look at an example, commission account, for all revenue accounts, besides the title, commission, rent, transport, etc., you have to add another term, revenue, income, or receivable, to differentiate that with the expense accounts because they take the same names, commission, rent, etc. So when you add this revenue after commission, or receivable or income after commission or rent or whatever, we will know that that is a revenue account where we are receiving money. And an increase in revenue is recorded on the credit side and a decrease on the debit side. The concept of double entry. Every transaction affects two or more accounts. If we look at this transaction example, on 1st January 2015, KK Traders started business with 80,000 shillings cash. So there is cash involved and we are injecting money in the business. So there is another account known as capital account. So a transaction affects two or more accounts. We We have seen an example with that. So there is an account that is gaining and another account that is losing. For every debit entry made, there is a corresponding credit entry. So if one account, you are entering the transaction on the debit side, then the other account or accounts will have the same entry or transaction being recorded on the credit side. The same happens to another account. If an account is to be entered on the credit side, the corresponding account will be entered on the debit side to complete the double entry, because there is value that is changing hands from one account to the other. So as we've said, on 1st January 2015, JK Traders started a business with 80,000 cash. So we have an asset cash that is increasing in the business. And we have capital that is increasing. It is additional investment in the business. So the cash account will appear like this. Since cash account is an asset account, and an asset account, when it increases, it is recorded, or that transaction is recorded on the DR side, we will enter that figure on the DR side, and we name that capital. So the cash account is receiving money in form of capital. The same happens to the corresponding account, that we enter that, but now we'll enter on the credit side to complete the double entry. So the capital account is receiving 80,000 cash. If it was stock, we would have written here stock, or a vehicle we are injecting into the business. So the concept of double entry looks at the accounts that will be debited and the accounts that will be credited for the same transaction, because there's movement of value or money or items. Then we need to balance the ledger accounts so that we can get the difference that will be used in the next accounting period. So an account balance is an accounting term meaning mathematical difference between the two totals of the debit and credit sides of an account. So these totals, the difference between the totals of these and totals of these, if we take this account, is what we are talking about as the account balance. If the debit side total is more than the credit side difference, the difference is called debit balance. And if the credit side total is more than the debit side difference, the difference is called credit balance. What we mean is this, that if this debit side is having a higher amount than this side, we call the resultant balancing figure or account balance as debit balance, because it means that this side is higher than this side by 78,500, because this side is the one with a larger figure than that other side. We are inserting this figure here so that we establish the difference. But that money actually belongs to this side. This is the side that has a higher amount than this other side by 78,500. The same, if you look at this bank account that we've drawn here, that this side has a higher figure than this side by 63,500. So we insert this balance, or we are establishing this balance so that on February, we will have cash in the cash box for use equivalent to 78,500 and money in the bank 63,500. So the procedure of balancing the ledger accounts, you identify the account title. Here we have the statement or the transaction. We identify the accounts involved. In our case here, we have the cash account and capital account. We identify the account title or titles. Then find the total of each side. Find the total of each side. This is 107,000 and this side has 28,500. After that, subtract the total of the smaller side from the total of the bigger side. You subtract 28,500 from 107,000. Insert the difference or account balance, as we had said, on the side with the smaller total as balance carried down to make the two sides equal. The difference that you get or obtain, you insert it on the side that has a lower balance so that you can have the two sides being equal. And then you call that balance carried down. Then you bring down that balance on the other side so that we call this balance brought down, because this balance, as we had said, actually belongs to this side. This side has a higher figure than this other side by 78,500. The same case applies to here. So this figure will be used in February. Thank you. Remember to subscribe and like my videos or channel. I'm Edward Kariuki Mathenge, KariukiEd2010@gmail.com. Thank you.